Welcome to Investors Hangout. SEBI has carved out 7 subcategories under the definition of hybrid mutual fund schemes. How to benefit from these hybrid funds is the topic of discussion in today's Investors Hangout, which is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. We welcome Dhirendra Kumar, CEO of Value Research. And Dhiren, my question is, what's the case for hybrid mutual funds when we have equity and pure debt funds?
Simplicity. Okay. And a lack of awareness about the market linked investments. Equity is perceived to be risky, and fixed income is perceived to be low risk or risk free. Deposits and money market funds, they are all nearly risk free and low risk. The fixed income funds, they go down in value, but the worst case, the nightmarish scenario in fixed income fund was that once in 20 years they went down in value by 2-3% when interest rates went up without much of an expectation. So the downside is much lower. What hybrid funds actually deliver you, they give you equity flavored with debt so that your experience is not disappointing, because most investors run away from equity and they are deprived of benefit that can be derived from equity because their experience is disappointing. Look at how typically mutual investors invest. They see that the market is going up. The market starts hitting mainline newspapers headline that market has reached a new high, and he sees his neighbors talking about stories that how they have made money, and he thinks one investor thinks that he has missed the bus, and then he starts looking for an opportunity that he should not miss the bus, and then he pools his savings and tries to look for an investment, and he invests. By the time he invests, the market falls. And this is what has happened in 1992. This is what happened in 1998. This is what happened in even 2000, as recent as 2008, or is happening right now. So when in the last lag of and this belief, when an investor gets excited about market, it is generally after a time when the market has gone up steadily. We were talking a few weeks back that small cap funds are up 30% annualized over the last 5 years. This is a very extraordinary return. So investors will get attracted to it, and they will invest, and they will see the decline, and they will take their money back, or they will keep waiting for their money to recover, never to come back again. So that for those investors, for anybody who has never invested in market or anything in market linked which can go down in value, hybrid funds are the way to go. They moderate your risk. And today SEBI has defined, there are now 6-7 categories, but there are only 3 meaningful categories which investors should consider, which is the aggressive hybrids. So you are ready to invest in equity, but you get scared of the big declines. Consider the aggressive equity funds, because the erstwhile balance fund, the previous used to be called as balance fund, because nearly 3/4 of the money or 2/3 of the money is in equity. Remaining in fixed income, market falls, they don't fall as much. Then you have the real balance fund, 50-50, 50% equity, 50% debt, and it rebalances automatically. You don't have to worry about it. Your 50% equity becomes 55% because equity has gone up in value. Fund manager will take money out from equity and put it in fixed income. Market goes down and fixed income doesn't go down, so he will take money out from debt and put money in equity. So he's buying low and selling high and all the time without any tax implication for you. Then you have the third one, where 1/3 of the money is in equity, 2/3 of it is in fixed income. Those are the equity income funds. So these are meaningful categories. They help you on board. They help you start swimming with the market in a manner which is which you can absorb better.
Can I compare it to the hybrid cars, for example? The benefits of environment-friendly cars along with the petrol version, and you have new, hybrid cars coming in, which are better.
No, I would say it may not be that. Yes, of course, it is a hybrid that you are keeping it
benefit
simple.
Of both.
Benefit of both,
yeah.
In that sense. But I would rather have try to have some anecdote in terms of, or an example which actually provides you the safety net, the parachute, moderate, initiate your experience in a manner that, you get used to it with greater confidence. Because I think, most investors are deprived of the benefit of investing in equities simply because the starting point is different. You also get greedy, and the market makes it, very extremely tempting. If you invest 1 lakh of rupees or 5 lakh rupees, what we keep repeating, even at the cost of, sounding like a stuck record, that invest regularly, never invest lump sum, even if you miss opportunity. Because the moment you invest 1 lakh of rupees and in 7 months' time it becomes 1.5 lakh rupees, I think you think differently. You become overconfident. You think in terms of borrowing money to invest because you have missed the opportunity. So, and that is actually the recipe for disaster, not having a systematic approach, because markets will be like this only. It will generate substantial return in a brief period of time, and it will lose substantial amount of money, or it will fall in value. And if you catch it wrong, then you are out of the market forever. And if you are able to, so this helps you calibrate, it helps you provide a mechanism of getting into an easy, sustainable, long-term ride with the market.
Okay. As mentioned by me earlier, there were 7 subcategories. Where is the need for that? Why can't we just keep one?
No, these, as I said earlier, that these 3 are the most useful ones.
Okay.
And of course, they provide you the rebalancing with the great convenience. You invest in one fund and it is taking care of your rebalancing without any tax implication to you. If you invest in an equity fund, and if you invest in a debt fund and you try to rebalance it yourself, you can well do it. But every time you make a transaction to rebalance, you will be liable for taxes. Investment of less than 3-year-old in fixed income fund is subject to, all the gains will be taxable as your income, depending on the tax bracket you fall in. All your investment in equity of less than 1 year will be taxed at 15%, and over 3-year older investment will be taxed at 10%, which is the capital gains, only on the gains. If you put it in a balanced fund, or if you put it in a aggressive hybrid fund or a conservative equity fund, you don't have to worry about this taxation. Then aggressive equity fund, they enjoy the benefit of equity. Now the differential is much lower, but it's there. So in that sense, they are tax efficient, simple, convenient, and rebalancing without any tax implication.
And so these are the best suited for the retail investors?
These are the best suited ones. And we have this legacy. We have the conservative hybrid funds, which were erstwhile, earlier they used to be called monthly income plans. Now they are not. They cannot be called monthly income plans, or some of them are still called. They have to change the name. These are 10, 15%, 20% allocation to equity, or the arbitrage fund. It's useful, it was tax efficient, but it was designed to actually cater to the need of a fixed income investor looking to derive the return in a manner so that it is treated as equity. So it was more of a tax dodge, so to say.
So
not a tax dodge.
Park our funds in the liquid funds then, instead of arbitrage?
Yeah, the difference isn't much anymore. For ordinary investors, if you are investing 10,000, 15,000, 50,000 rupees, it doesn't make a difference unless you have some sizable money and on which this tax difference of equity, because less than 1 year old investment in arbitrage will be liable for 15% as compared to a liquid fund which will be treated as your income. So maybe for companies, but for a small amount of money, the effective impact will be very less. So I think for common investors, it is more of a tax planning tool. This multi-allocation asset allocation funds, they invest in equity, debt, and gold. This may not be a meaningful category, because I generally avoid suggest investors that avoid gold. It's not a great investment. Then you have the fourth category, which is dynamic asset allocation, where the fund manager takes a call that how much money has to be invested, because unlike the frozen allocation, why I like the frozen allocation, that investors exactly know in the conservative, the equity savings fund, the balance fund, and the aggressive hybrid funds. You know what you are getting into and what the allocation will be, because I am looking at these funds, hybrid funds, as the key benefit as the automatic rebalancing. Whereas the dynamic asset allocation funds, the fund manager takes a call that he should be 0% into equity or 100% into equity. He has absolute flexibility, complete freedom to invest wherever he wants to. He can be 100% into equity and 0% into equity if the need be. And my sense is that most fund managers have got it wrong. Nobody has been able to prove their credentials that they can call it right. Only one fund has a long track record and has been able to do it reasonably okay, which is a dynamic PE ratio fund where the allocation to equity and debt changes depending on the level of the market, level of the priciness of the market. So depending on the PE of the market, the allocation changes, and that has got it more right more often than the active fund managers taking a call on equity and debt and where to be invested.
Okay, so the most suited for retail investors, aggressive hybrid funds, where equity is 65 to 80%. Yeah. Then balanced hybrid funds, equity 40 to 60 or 60 to 40.
Yeah, equal 50-50, so to say.
Okay. Yeah. And equity savings.
Equity savings.
Which is
a third of equity.
MIP.
No, these are equity saving funds. The MIPs are, now called conservative hybrid funds, which invest up to 25% into fixed income. Okay. Into equity, not fixed income.
Yes. So, hope you've understood how to benefit from these hybrid funds. We now move on to the Q&A part of our program, and the first question is from Sandeep. I have recently retired. Should I invest my retirement corpus in aggressive or conservative hybrid fund?
Depends, because in your retirement you need to plan this carefully. If you have 50 lakh rupees to invest, and what kind of income are you expecting from this, depending on that, and how much dependence you have. If your investment is going to be a supplementary income, or maybe you don't need to derive any income. If you don't need to, if it is just an investment and you are not expecting any periodic income from this, maybe aggressive hybrid is good enough. This is a nice way to start, but at the same time, don't invest all your money at one go. Because you have retired, you have got the money, and don't write a check tomorrow. You have to average your investment, which is so critical. Okay. It has been accumulated over a long period of time. It cannot be exposed to the risk of catching a market high. You cannot invest all the money so that if the market is at an all-time high and market corrects or goes down in value, all your money should not go down in value. You should be able to average it. If you are going to depend on this investment entirely for your income, then it requires a far more careful planning. Some of this money should actually get into senior citizen savings scheme, other things, other investments, the post office MIP. No, the interest is somewhat maybe lower, but you have guaranteed returns. For a certain part of your money, you will be getting guaranteed return and you can bank on it. If you don't have the need for a guaranteed income, because if you are getting some pension, or if you have other source of income which is predictable and you don't have to depend on it on a month-on-month basis, you don't need to worry. Then you can well invest in the conservative hybrid fund. If this investment is going to be a supplementary income, you are not going to depend on it entirely, but once in a while, every 2-3 months, if you get 10,000 rupees or 50,000 rupees, depending on the amount you are investing, then even the conservative hybrid funds will be okay. More importantly, I think generally for most investors, many investors who have not asked this question, but I keep getting this question more often, that I have this much money and I want this much income. How much is good enough? Because if you and most investors' need in retirement is to have a set of have income, which is not only good enough for now, but keeps rising over time. Because next year, and at least gets inflation adjusted. If you earn 50,000 rupees today, if you are able to derive 50,000 today, maybe 3 years from now you will require 55,000. And for that you need to necessarily invest in the conservative hybrid fund or aggressive hybrid fund, depending on the amount of money and your need for income. Because these are the only vehicles which will provide you the inflation protection. All fixed income investment which retirees are used to will not provide you the inflation protection. Because if you invest in a post office deposit or a fixed deposit or senior citizen savings scheme, guaranteed return is fine, but capital remains constant. So your income will not rise. On the other hand, income will go down because interest rates are on their way down in times to come.
I think it's lots to do with the mind, the way they condition their minds. They like to invest in fixed deposits, and somebody needs to, they need to understand.
No, it's a lot more than that. one is that, historically we have earned good returns on fixed income, but in future we may not, and interest rates have come down. The other is the way we have experienced equity. Most Indian investors, the way you invest in equity, it has generally been disappointing. Third is that, lack of understanding. People don't know how things actually work, why equity gives you more return, and why it turns out to be risky, and how to benefit from it. Also, they don't understand the tax implication of it. If you invest in equity and you hold it and you design a withdrawal plan out of it, your tax implication in the initial years is so low as compared to investing in making a deposit, earning that income, and getting it taxed. And it is subject to TDS if the interest income is coming by way of interest. Over and above that, if you're in a higher tax bracket, if that adds to your income, and if you're in a higher tax bracket, it only adds to higher tax outflows. So understanding tax, understanding how things work, how these returns are derived, the relative riskiness of it, and is volatility a risk, and a belief in the time frame and how it reduces risk, that is very low.
We move on to the next question asked by Ajay. I have a long-term horizon and I'm convinced to invest in equity, but I don't have debt exposure in my portfolio. So therefore, should I invest in an aggressive hybrid fund just to get some debt exposure?
Ideally, that is a good starting point and it's a very tax efficient way, but you should not. If you necessarily need to have debt exposure, the need should be, we need debt for 2-3 reasons. One is the emergency fund, the money which you might need in an emergency, and it should be invested in a manner that it is not exposed to any market risk. So that is an absolute sum. It is not a percentage of your total, because your net worth could be anything, and that should be the starting point. Whether you need 50,000, whether you need ₹1,00,000, whether you need 25,000 is up to you, depending on your situation. If you have young children or old parents with you, you need higher emergency fund. So think about that. That money should be in fixed income. The other need for fixed income in your portfolio is to have a percentage so that you can rebalance. If you decide on, if you are convinced of equity and if you have chosen to invest in equity, 15-20% of your money or 10% of your money should be in fixed income, so that if equity goes up substantially, you are able to take out a little bit of it and put it in fixed income, which will never go down in value. So you are able to de-risk your portfolio a little bit, but you can do without it in your early years. As you get closer to your retirement or the need for consumption, not retirement, but at any stage when you need to really work in a manner that you are likely to consume it in a foreseeable future, 1 year, 2 year or 3 years time frame, that is the time when you should start moving your money partially into fixed income. So you should have fixed income for rebalancing, you should have it for the emergency fund, and you should start moving to fixed income depending on when you need the money and you start moving into safer territory.
Radhika says, I have an investment horizon of 5 years. Should I invest in a multi-cap or a balanced fund?
To be conservative, invest in a balanced fund. Also in the coming times, more recent future, I think that the market will be volatile, and balanced fund which is very disciplined and rigorous with its rebalancing will generate more return. Also for your exact 5-year time frame, it will not prove to be great disappointment, and the comfort of stable return with growth will be far higher.
Okay. Though you have answered the next question, but still if you could mention about the difference between arbitrage and equity savings fund, as asked by Shreya.
Yeah. Oh, they are very different. Arbitrage fund will will give you return like a liquid fund. They invest in equity derivatives and equity in a manner that they are able to generate returns which is of a very lowly kind. So think of arbitrage fund as liquid fund, except that the tax treatment will be like that of equity. Whereas equity savings fund, a third of the money is invested in equity, 1/3 of the money is invested in arbitrage, which is like liquid fund, and 1/3 of the money is invested in fixed income securities. So it will get you, it will get you lower return than balanced fund over a long period of time, but with far greater stability, and the tax treatment will be like that of an equity.
Okay. Shubhankar says, I want to invest 1 crore and create a regular fixed income. Which will be better? Option, fixed deposit or systematic withdrawal of 6% per annum from a top-rated equity hybrid growth plan?
Oh, undoubtedly, 6% withdrawal rate from a top-rated hybrid growth, aggressive growth fund, or even a balanced fund, and implementing a systematic withdrawal plan of 6% will ensure that your income will be inflation adjusted. I hope that it will be inflation adjusted, and if in the next 10 years, 15 years, 20 years, sometimes you have to take a small cut of income of not 6% but 5%, that will be okay. But 1 crore invested in bank deposit will ensure that you will never be able to raise your income. And so 1 crore fixed deposit, senior citizen savings plan, even if you are able to derive 8.5%, which mean only 8.5 lakh now and for all times to come.
Right.
Whereas on 1 crore rupee, if you are able to do a systematic withdrawal plan of 6% withdrawal, then it will mean 6 lakh rupees today, but it will keep rising over time till you live, and your capital remains intact over time.
And the cumulative benefit.
It'll keep accumulating. So I think undoubtedly, if you are able to understand this concept, withstand the ups and downs of it in the interim, I'm confident that this 6% will prove to be a bonanza for you to ensure sustainable income.
Okay. Jacob writes, bank fixed deposits compound annually. How frequent is the compounding in mutual funds?
They work very differently because banks give you interest they give you interest. So in fact bank interests don't compound annually, they compound quarterly. So every 3 months, assuming that you earn, bank gives you a interest of 6%. So 6% interest on your 3-month deposit will be added to the capital, and the next 3 months you will again get interest on interest which was added to the capital. So it compounds, the compounding is on a quarterly basis. Mutual funds don't work like that. Mutual funds NAV is calculated every day. And mutual fund NAV is calculated every day based on the value of the underlying investments when markets open, equity and bond markets open, and all the securities are traded thereafter during the day. Depending on the end of the day value, the sum total of all that divided by total number of units less expenses is the value. So you can say that mutual funds compound every day, but depending on the underlying worth of the assets, if the prices go up or go down, they compound or decompound every day.
Okay. So no matter what, over a period of time, that NAV of that particular day will determine how much you have earned.
Yeah, the right comparison will be that, bank fixed deposit and liquid fund. That is the most comparable, or a debt fund. I would say that debt funds compound every day.
Right.
Liquid funds compound every day, while fixed deposits compound quarterly.
Okay. Last question here. I have recently invested 1 crore in a single fund for long term. I'm expecting a CAGR of 26% per annum. Is this the right step? Says Kamlesh.
I don't know which fund you have invested in. If you have invested, generally speaking, investing 1 crore at one go is a very risky and a very dangerous thing. It might just turn out to be okay for you, but it has generally proved to be disappointing for many people, because reducing the possibility of catching a market high is a very crucial objective of any investor investing in anything to do with equity. 26% per annum over what time period depends.
So
I don't know.
Kamlesh could write in to us and give us
with more information so that we can
answer.
We can suggest.
Okay, that's all we have in today's Investors Hangout. No matter what the fund, as Dhiren always says, continue to invest regularly. Till we meet next time, this is Rajesh Lake and Dhiren Kumar saying goodbye.